Welcome to iGlobal Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you very much for joining me. Well, to start off the new week, the Australian dollar has found itself on some bearish ground. After Friday, the market plummeted in Europe and in New York as the greenback across the board strengthened. The market pretty much since the rejection from the 78 level, and first of all we had a shooting star, then we had a bearish outside range day. The shooting star was confirmed, the 60-day moving average was rejected at 78.18, and this sent a tumble for the Australian dollar, and now very much set up for the challenge of 76.30.35 for this week. The technical implications also are pretty much supporting from the MACD and also from the stochastic that a further decline will eventually emerge. A challenge of 76.30 and breaking it beneath this level would give us the next target of 75 cents. Resistance on the day seen at 76.95.05. For this week, the economic calendar will be looking to the quarterly CPI figures early Tuesday. Now the quarter-on-quarter CPI for 2018's first quarter is expected to read at 0.5%, previously was 0.6%, while the RBA trimmed the mean CPI is also forecast at 0.5%, a tick upward from the previous reading of 0.4%. Overall, the market will be keeping a very close watch to these figures, and also, as I said, I believe the market is starting to stage more of a bearish sentiment, but we do need to take out the lows of March to get the exposure to 75 cents. A very interesting price action for the US dollar on Friday. Now, the dollar index did stage quite a significant move and broke back above 90, but not above the broad uptrend, which comes in when Trump first came into the Oval Office and when the market peaked at 14-year highs around 103. So from 103, the downtrend now comes in at 90.40. Market's just trading around 90.05 at present. Now a break above this level after printing a high of 23 is the fact is that we could see further gains for the US dollar, and this in turn would actually put pressure on this double top neckline. Now, a double top bearish reversal is when the market has 2 points, and with the neck coming here, the measured move from the head to the neck is the destination to the downside from the break of the neck, a little bit like a head and shoulders reversal. So a break of 121.80 would give us the projection to the downside of a 118 region, very bearish case. So do keep an eye on this level if you're trading the euro. And also, if you're trading the dollar index, keep an eye at 90.40, because above there will give us a target around 93 as a potential short-term level. The dollar yen just climbing over this 107 level. It is struggling a little bit here. I would like to see more of a dynamic rally here, but the technicals aren't fully set up for the move. But nevertheless, we are trending for one. And there is a little bit more room to the upside, so we could eventually see a target of 108.55 to 109.15. Support on the day comes in at 107.35, but do be on your guard. We do get a failed attempt at this level would see the market tumble back towards the recent lows. For 4 consecutive days, the pound has remained weak and now crushes the level of 140.35.45, which was the broad uptrend. If we take a little look from here, which emanates around 131, it was a 10 big figure level in terms of the trend. The break of this level does give some significance to the downside and a target of, at the moment, of 138. What began the move was last week, the Bank of England governor, Mark Carney, who said that, and also a very familiar story like we heard in November, that the next rate hike might be a little bit slower because of the Brexit. But I feel that the market is still set for a tightening in May. Therefore, we could see a small rebound if we get down to the region of 138. But nevertheless, Here's the fact is that also from the Bank of England was Michael Saunders, who is a hawk normally, but made some dovish comments over the weekend, saying that the UK rates probably need to move over time to something more neutral, but not too quickly. But I would say from the given 4 days of weakness, is there still room to the downside? So see how it plays out with the resistance seen at 140.55. Gold tumbled heavily on Friday, and with the strength of the US dollar coming through, and also geopolitical tension easing somewhat, as we saw $14 of gold weakness, and now looks towards the region of 30 to 24.26 after backing away from the highs, the multi-year highs to be in fact, of 1,360 to 65. Nevertheless, the market is still a little bit weak, and from the technical point could still get down towards this region of 30 to 24.26 before turnaround. Resistance is seen around 38. Silver, a little bit weaker, and just be on your guard that the market is still looking down towards this break level of $16.85. I still believe the buyers will be there. The technicals haven't really broken down like gold, so we could see another re-challenge to the upside around $17.50. So the broader range for this week, $16.85 to $17.50. And rounding off with oil, well, it seems that President Trump took to Twitter at the weekend and having a slight stab at the OPEC. He blamed them for artificially putting prices up high. But the Saudi energy minister quickly came back to the defence and said no, not such a thing as artificial prices. Nevertheless, the market did drop to a low of 67.44 on the back of Trump's tweet. Now, at this stage, the uptrend comes in at 62.5, and there is support for it seen around $66 a barrel. So if the market is still a little bit jittery about this tweet, then we could see some weakness towards that region. Resistance at 68.75.80 on the day. Well, that wraps up for today. Thank you very much for joining me, and I hope you enjoy the rest of the day and a great start to the new week.